Welcome everyone. Let me start with a simple question. Can a company remain profitable, remain debt light, keep its brands alive, continue selling crores of units every year and still destroy shareholder returns for 5 years? Relaxo says yes. At one point, the market was willing to pay around 145 times earnings for Relaxo. Today, the same stock trades at around 40 times earnings. The share price moved from around 1400 rupees at the peak to now nearly at 300 rupees. And this happened without the company going bankrupt, without a fraud, and without business disappearing. So the question is not whether the Relaxo is a bad company. The question is what was the market expecting and what happened when that expectation did not meet. This is a case study for today because Relaxo is not just a footwear story, it is a valuation story. It is a lesson in growth expectations, consumer price sensitivity, volume growth and PE multiple compression. Footwear is an interesting category because it sits between a staple and discretionary product. People need footwear. Relaxo was built exactly for the mass Indian consumer. It sells sleepers, sandals, sport shoes, school shoes and other daily use footwear. Its brands include Relaxo, Sparks, Flight and Bahamas. This is not a luxury footwear business. It is a value footwear business. So the investment thesis of the market was very clear. India is under-penetrated in branded footwear. Consumers should gradually shift from unorganized to organized players. Relaxo has already established brands in affordable categories. It has deep physical distribution. Historically, company had controlled working capital and produced healthy return on capital. So Relaxo should compound revenue and profit for years to come. This expectation of the market led the PE multiple of Relaxo stock touch as high as 145 times by the end of 2023. But by the end of 2025, the PE multiple of same stock was at around just 40x. The price of this stock fell from high of 1400 per share to currently at just 300 rupees per share. The stock has given negative returns for the last 5 years. So the question is, why does the share price of Relaxo fall despite it being a good business? What was wrong with the investment thesis of the market? And lastly, what are the investment lessons that we can learn from this case study? We will break this case study into two parts. First, we will understand what the 145 times PE multiple actually means. And secondly, we will look into the business side of the Relaxo. Let's first understand the real meaning behind 145 times PE multiples. A 145 times PE multiple is not just a high valuation. It is a very specific corporate finance statement. If a company earns 100 crore rupees of profit and trades at 145 times earnings, the market value is 14,500 crore. That is an earnings yield of only about 0.7%. So the investor is not being paid by today's earnings. The investor is being paid only if future earnings become many times larger. So when market paid 145x for Relaxo, it meant that Relaxo can grow its earnings at a high rate for a very long time while protecting return on its capital. Since Relaxo was earning 20% return on its capital and reinvesting 60% of earnings back into the business, discounted cash flow method suggests us that the market was expecting the earnings to grow at around 12% CAGR for a very long period of time. Now let's look at the second part, Relaxo's numbers from FY24 to FY25. In FY24, Relaxo sold around 19.5 crore pairs. In FY25, that same number fell to around 17.8 crore pairs. At the same time, average realization improved from 148 rupees to 156 rupees per pair. This means that although the average realization of pairs sold increased, the volume of pairs sold decreased. Now, there can be three major explanations for the volume fall. Reason number one, the value consumer was under pressure, and as we know, Relaxo sells to value conscious customers. For this customer, footwear is necessary, but replacement can be delayed. The customer may not buy a new slipper this month, or the customer may shift to a cheaper local brand, or the customer may reduce the number of pairs purchased in a year. During FY25, the rural and middle income consumers faced inflation pressure and weak income growth, which may have made them to postpone the footwear purchase. Reason number two, consumers may be shifting to cheaper unorganized competition. This is the most important consumer behavior point in the case. For a premium consumer, a 50 rupee may not matter, but for a value consumer, 20 to 50 rupee can change the decision. So a brand can have a recall value and still may not have enough pricing power. People may know Relaxo and they may trust Relaxo, but if a local product is materially cheaper and a consumer is under pressure, some customers will downtrade. And lastly, reason number three, Relaxo was restructuring its distribution model. The company moved towards greater transparency, better retailer level data, and a lower dependency on weak quality distributors. Strategically, that may be the right thing to do, but operationally, it can hurt near-term sales. If distributors resist a new system, if low quality distributors are removed, or if company stops pushing inventory into the channel, then reported volume can fall even before the consumer story fully improves. These are the problems because of which the volume of pairs sold fall in FY25 compared to the previous years. Now let's connect these two parts. Market, when pricing Relaxo at 145 times earnings, was expecting a continuous growth in its earnings at a rate of 12% every year. For earnings to grow at 12%, the volume of the units sold by the business should at least grow by 8 to 9% every year. That means the market was expecting the volume growth of the business at a rate of 9% every year without any break in any single year. But in reality, this didn't happen. Relaxo's volume actually degrew in FY25, and once volume fell, the market could no longer justify 145 times earnings. This is the reason behind the derating of PE multiple from 145x to 40x. Now, the stock price is simply earnings multiplied by PE multiple. During FY25, earnings came down by 15% and PE multiple derated from 145x to 40x. So, this put double damage to the stock price. And this is the reason behind the fall of the stock price from 1400 rupees to 300 rupees. So the market was not wrong about the competitive advantage of the business, but what it missed is the question that can Relaxo deliver predictable high volume growth in a category where consumers are price sensitive? That question would have forced the market to challenge such high PE multiple. This brings me to the lessons that we can learn from this case study. Lesson number 1. Do not confuse brand recall with pricing power. Relaxo has strong brands, but management commentary pointed towards weak demand, rising competition, and consumers downtrading. The company chose not to aggressively reduce prices, but volumes were under pressure. So when analyzing any consumer company, do not just look at the recall value of the brand. Look whether a brand can protect both volume and margin when the consumer is under pressure. Lesson number 2. Revenue growth can look healthy even when volume growth is weak, especially if average price realization rises. But long-term compounding needs sustainable volume growth. So for every consumer company, split revenue growth into volume, price and product mix, and look how each of them are growing. And finally, lesson number 3. A strong balance sheet does not remove valuation risk. A debt-free balance sheet is a positive, but valuation must still be matched with earnings growth, durability and return on capital. We can't pay very high multiple unless there is a clear visible earnings growth in the future, which is kind of difficult with a lot of businesses. So here is a step-by-step process to judge a business. Step number 1, pick a company from your portfolio. Step number 2, write its business model in one sentence. As example, Relaxo is a branded mass market footwear company selling value footwear through large distribution and in-house manufacturing. Step number 3, break revenue growth into volume and price growth. Then find out whether the growth is coming from selling more volume or higher realization. And when you are done with all these steps, decide the business quality, earnings growth predictability, volume, balance sheet strength and whether valuation makes sense. And to end this video, Relaxo teaches us to decompose the revenue into its separate components. For sure, Relaxo has seen its volume fall, but the deeper question is this temporary demand pain or is Relaxo structurally losing relevance in changing category and channels? This is on you to decide. And that was the end of this video, and I hope this was valuable to you. If this video provided some value to you, please like this video and subscribe to this channel for more such case studies. Thank you so much for watching. I will see you in the next video.